Hello, good afternoon. Welcome to MF Corner on CNBC TV 18. I'm Vinnii Motiwala, with me Sonal, Bhutra as well. Sonal, today is interesting, right? Markets have been so volatile. I also want to know what should I do with my mutual funds, and I want to understand how to go about it as well. That's what we're going to discuss, right? Today.
We are going to, and you know, this is the time when we really need a voice that can calm the nerves and tell us how to go about things when the market is so volatile. We are seeing something coming up every day when it comes to the geopolitical arena. Markets are grappling with them. Investors often find themselves at the center of these issues, right? So how should you navigate market volatility? Should you stay put? And what happens with your mutual fund portfolio? We'll discuss this and more with Swarup Mohanty, the Vice Chairman and CEO at Mirae Asset AMC. Swarup, such a pleasure to speak with you as always. Thank you for coming down to the studio at a time. Everyone has the question what to do next, especially mutual fund investments, right? Because people say that, okay, we've seen some gains. Should we take off some gains from there? So first up, what are you making of the markets right now? There's so much happening.
It's good that so much is happening, right? And, you know, in volatility always lies the opportunity, and it's a good time to be an asset manager, I must say. Because when you look at the globe, a lot is happening at the globe. And then you narrow it down on the asset you're owning, and the asset called India is a good asset. You ask any fund manager what he or she would like to do, a simple answer will be own a good asset at a good price. Because of all this volatility, you're getting this good asset as a good price. So make no mistake, the accumulation which is happening at these prices, from a long-term perspective, only strengthens the portfolio. If that is good for the fund manager, it's good for the investor too. And so much has happened. We're talking about, I personally believe there was life before Christ and after Christ. Then I've come on shows and says the life is before COVID and after COVID. Make no mistake, it's life before tariffs and after tariffs.
Right.
It's a changed world. When the largest economy changes its behavior, every country will change its behavior. And in that behavior change, so good to see India standing tall, sticking to its core, not doing anything rash, in fact taking it head on. Don't mistake the impact which GST can have in the economy in the times to come. India is a consumption economy.
Correct.
And the best way to push the economy is to start with consumption. We didn't wait for things to happen. We've taken it on our side. See that, couple it with RBI now taking a more growth-oriented stance. So the policy making has made it its own thing to come out in the front and take the economy head on. You know, that's so refreshing to see. And if in the worst days this economy is growing at 6%, when the globe is tottering at 2 to 3%, this is a good asset and it's good space to be in is from an investor perspective.
Absolutely, Swarup. Good afternoon, and first of all, happy festivities to you as well.
Thank you so much.
From all of us here. So hope you have a great time after the show, and we want to have a great time post-COVID.
And during the show as well.
During the show and post-tariff scenario for investors. Right now, do you think there is any of this asset class which would provide a better opportunity or where someone can make more money?
No, I think the underlying has changed dramatically. Let's look at what we call the democratization of the market. India for the last 2-3 years has been the largest public issuing country of the world. Okay, and most of the new issues have come in the mid and small cap space. The market has become broader. In 2016, now I'm not advertising, but I'm stating a fact that we closed our mid cap fund, stating that we didn't have ideas. Today, fund managers have more ideas often than on the mid and small cap space. So to catch that length and breadth of the market, you have to invest very differently from your yesteryears. Due to the rate cuts, debt is again back in play. Duration can be a play again. And at a time when global treasuries have more gold than dollars, you have to rethink the question, is gold a hedge or is it not, right? And along with gold, there is silver. The point I'm making is all the rules or the erstwhile allocation rules need to be rechecked. Portfolios need to be rebalanced to catch the length and breadth of all asset classes.
Rebalance to get in gold?
I mean, see, it depends on the risk profile. I have this thing about not gold, any asset class. Returns always come in a lumpy nature. It's just 2-3 years which make up for 7-8 years. Indians, I believe, are suited more to make money in gold because they hold it. They hold it for 10 years, 20 years, and catch those lumpy years more often than other asset classes. If you apply that same rule to any good asset class, you make money. From the equity side, they've not waited for those lumpy years. There have been more timers, and the last 2-3 years flow are very cognizant of that. It's been brash return changing. Just last one return kind of comes into the portfolio. You change that to the behavior of gold, same investor.
Yeah, that's true.
You know,
Yeah.
you make money, right? Whether it's gold, debt, or equity.
But isn't it now more FOMO situation if I enter gold now? What, like,
How do you know? How do I know?
Because I was looking at it at 2,600. I was like, oh my God, it's expensive. Now look at where it is.
Vinnii, I've been thinking yesterday from 2001. I've been making this presentation called Investing in Volatile Times. Market at all-time high, how many times have you done a show? Right? So you don't know. So better to be allocated in that and allocate as per your risk profile. Yes, between gold and silver, there is a risk profile coming in. If you want good risk-adjusted return, maybe gold. If you are a slightly higher risk-taking ability, maybe silver. But the point I'm making is you need to rethink whether it's just a hedge or not. That was the erstwhile rule. All those rules stand changed.
That's true. So, you know, while you're saying for long-term investments, you have to stay put. Before tariff, after tariff, life will change, but long-term goals, so to say, should remain same in terms of allocation as well. SIP inflows, every month also we talk about the word record high SIP flows, but cancellations also are growing, right? At a point in time, it was around 50%, it grew to 70%, 80%. What's happening here? What are you as a fund manager making of that?
I mean, see, the market is getting its net money. So market is happy. The investor who's stopping before the goal is achieved needs to think. And that same investor, I always tell somebody who redeems on market timing, just write down your exit NAV and go back 2-3 years later and check that exit NAV of that particular fund. Invariably, all of them would have been wrong. Because this is a country which is going to double its economy in 8-10 years. And one of the best ways of owning this growth of the economy is through the capital markets. And the only person who will make money is who's going to sit. No? In mutual fund data says that only 2 people make money. Somebody who's lost his or her account statement and the other person who's dead, right? So the person who has to hold this asset class as per the risk profile will only gain. Yes, it is very sad to see SIP stopping purely on market timing. Just states how much of work you and I have more to educate people. And if they think that we know better, then why are we salaried individuals? Okay. But it's just you have to play the course, right? But at the end, what is happening? Somebody is stopping, some more money is starting. So the net market continues to get more money. Hence, the market is a place where a buyer and a seller meet, right? There are more buyers in the market. Hence, it is meeting its own goal or its own path.
You know, what about global international markets, right? Every time you talk to investors, now they're more interested in international markets. They know that I want exposure, you know, maybe in US, maybe anywhere else, that China, is it an opportunity? Anything specific that stands out for you?
No, I mean, that realization is not wrong. All said and done, and taking nothing away from Indian markets, just 3% of global market cap, right? So owning some of those economies makes sense on your portfolio. Some of those companies or those businesses are not in India. So diversification is key, right? And when you have economies like US, which have run away, and I personally believe that, you know, maybe things are looking a little tight for China. You have to look out for China for the next 10-15 years. So if you are owning those economies, they are more diversified. More often than not, you can catch some incredible growth businesses from there. So diversification is genuine. I mean, it's sad that mutual funds are stopped for those allocations. I wish they were open, but some incredible stories which play out there could be owned by Indians.
So there have been any conversations about that limit?
Not that I'm aware of.
No, just generally if the industry has asked for an improvement in that limit, because there are very few international funds which are open for subscription.
So we only become open when we get some redemption.
Correct.
Unfortunately, we have Mirae Asset Fang Plus, which is not getting redeemed. So we are absolutely shut. But what has happened is through the LRS route, a lot of investors can own this through the gift city.
Yes. Okay, so that's a different conversation altogether. We'll discuss that, actually a lot more other than that, in the next part of this segment. But we have to slip into a quick break and we continue our discussion with Swarup Mohanty of Mirae Asset AMC. Stay tuned for that conversation.
Welcome back to MF Corner on CNBC TV 18. We still have with us Swarup Mohanty, Vice Chairman as well as CEO at Mirae Asset AMC. And we're discussing how should you be investing in this volatile market, right? We have discussed what's going on right now, what we're looking at in terms of global front as well. But Swarup, my portfolio allocation, how should I go about that? And how should I look at it right now? How should that allocation actually start panning out as an investor?
So I think it starts at the portfolio allocation grid. And suppose, say, for discussion's sake, if the grid was 70-30, 70 in equity and 30 and if the markets are down a bit, it would have come down, say, to 65 and that would have gone up. So your fresh allocation has to be equity. The more you make it mathematical, the easier this answer becomes. You stop the market, it takes its impact on the portfolio. If the market goes up 10%, then your 70 goes to 75, 77. So your next allocation goes to debt. And that you do a yearly rebalance, and that's what it is. But
what about mid and small cap also? Add that also.
That's the right question. In fact, because of what's happened in the last 2-3 years, and make no mistake, lot of public issuances have been in the mid and small. Hey, the AMCs were not there, so hospitals were not there. A lot of chemicals have come into small caps. So to catch the length and breadth of the market, invariably you have to allocate more to mid and small than you used to because of lack of ideas. So I would definitely allocate a little bit more to mid and small. Till, say, before COVID, I was not a small cap investor because my portfolio requirement was 11 to 12%. But some great stories are compelling me to go there. And to be fair, I think the liquidity there has increased dramatically compared to what it was. The market is getting structured. So especially the small cap, I would recommend play it through a manager, not try your luck on your own. But I am in print saying that Vinnii is a mid-cap story. It will perpetually remain a good mid-cap story. So allocate maybe a shift a little bit of what is happening on the large cap side to the mid and small. But what's very interestingly, the flexi caps of the industry have started behaving like flexi caps and not the erstwhile large cap oriented. So the fund managers have started, expressing themselves better. So investor is in better hands now.
I think the expectation in terms of returns is also, I would say, has gone higher post-COVID. When you said earlier it was 11 to 12%, now suddenly everyone wants higher returns immediately at the tip of their hands. So I think, as you said, with small caps, go play it via a manager, play it via someone who has an expertise in that particular field because it can be very volatile as well, small caps and mid caps.
But Sonal, returns have to be mitigated to market realities. I mean, typically if you track the Nifty 50, which you guys do, it's money double in 5 years, roughly, if you would have seen traditionally. Now, what happened in COVID, the markets crashed, gave it a beautiful bottom, and hence the last 3-4 years have been an aberration. Now, you can't build your story on aberrations. From here on, it will revert to that.
Exactly.
So, good 11-12% is a doable on overall portfolio basis.
A lot of new investors came who didn't think the entire way. That's the reason.
It's because we were spoiled also, and after COVID, I think everyone's like, oh my God, I'm going to get fabulous
But you've
return.
got good returns, no?
Yeah, but in last year, what you saw as a return, you're like, oh my God, am I going to continue seeing that? That is not something...
Someday it was going to happen. I mean, if money making became so easy, then everybody would leave everything and do just this, right?
Yep. Okay, but in that case, we have spoken about India being a good asset class, but valuations also were some concern at a point in time. In that case, within the markets, any margin of safety that you are looking at?
Yeah, I think in pockets we are still pretty confident of getting good margins in financials. Healthcare always remains a favorite of mine. Perpetually, you have good stocks at good pockets there. I think non-FMCG consumption is looking quite okay. And then this GST should throw up a lot of future there. So I think in pocket, especially mid and small, still remain a good stock pickers market. And mid and small, I would definitely play through a manager in these markets. But a good manager has a good play. Please understand, markets always remain cyclical. My asset allocation is always inversely proportional to last 1 year return. So you catch the non-cyclical part of the market in your fresh purchase. A fund invariably whose cycle has played out actually plays out at the top, but if you compare last year funds to this year funds, it's gone upside down. And so if you allocate a little prudently and not just follow the past near-term returns, your portfolios can become even stronger.
Swarup, how should a new investor or someone starting out right now start their journey with mutual funds? How should they look at it? What would be a better option right now for them?
No, I think every asset class comes with its own way of working, right? To understand the asset class, always better to understand the volatility of each asset class, and then you understand your risk profile. Nobody is born with a risk profile. You understand your risk profile as you play it. I would start with the broad index, either an ETF or index, whatever suits you. Understand the market, broad market. Once you get a little aware of the nuances of that, then you start growing a little ahead. And that's what we've seen in the industry. The number of folios which have come into passives over the last 4 or 5 years have been pretty telling of this fact that investors are now cognizant of buying broad market and then understanding the asset class. And that's the right way of starting. But before that, one has to allocate, be very clear of how much to allocate. And that how much to allocate comes from your goal. First, set your goals. If you don't have a goal, then don't invest. Keep it in the bank. If you don't know why you're investing, you will never know where to invest. So that why is most important. Your why and my why will be completely different. Hence, it is called personal finance. It's everybody's person, right? So get that in place. Earlier, there was this thing that information was not available. Now that is not so. So read a bit. If you don't take care of your money will not take care of you.
Yeah.
Right.
And you need to make your money work for you as well.
Yes, absolutely. There's enough there. Just at your phone you can do, but
my one point I just want to know is in terms of, you had said, right, gold also is a good bet right now. So if I'm looking at mutual funds right now, should I see allocation whether it's higher to gold, silver or something? How do I go?
But here's my unlearning post-COVID. The beauty is that, when you go through a multi-asset structure, the chances of getting a median return over the longer term is higher in a multi-asset strategy than a pure one asset strategy. So that's where you do not know when that lumpy return will come. You have to allocate across asset classes to catch those years, and you have to be there, right, invested. You can't make money if you're not in the market.
That's
Right, so these cash calls and all don't make sense to us. We always remain fully invested, and to catch these years.
Portfolio diversification, that's the word.
It's been an unlearning for me, and in a good way.
All right, but we are learning from your unlearning. So thank you so much, Swarup, for joining us today, taking out time and explaining to us different contours of investments and saying it's very personal. So go with your risk and return possibilities. With that, we'll do one thing. We'll take your leave on this edition of MF Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.